Everywhere we look, people are searching for ways to grow their money. Some chase hot stock tips from television. Some follow experts who promise easy riches. Others leave their money in mutual funds or retirement accounts, hoping the professionals know what they are doing. But in reality, most of these methods fail to beat the market. The truth is, investing often feels like a mystery game designed only for the wealthy or for Wall Street insiders. Joel Greenblatt wants to change this idea completely. He tells us that the stock market is not a casino and it is not a secret club. It is a place where ordinary people, even beginners, can build wealth if they understand a few timeless principles. The surprising part is that these principles are simple, logical, and available to everyone. You do not need advanced math skills. You do not need to read endless research reports. You only need patience, discipline, and the ability to follow a clear plan. This plan is what Greenblatt calls the magic formula. It is not a trick. It is not about quick profits or gambling. It is about choosing good companies at the right prices, then allowing time to do its work. Over years of testing, this formula has shown that it can beat the market, often by a wide margin. But before we can understand why the formula works, we must learn something deeper. What makes a business good or bad? Why do some companies grow stronger and richer over time, while others struggle to survive? And why does the market sometimes reward weak businesses with high prices, while ignoring great businesses that are undervalued? To answer these questions, Greenblatt starts by taking us to the two extremes. He shows us first what the worst kind of business looks like. A business where profits are tiny, competition is endless, and the owners can barely survive. It is here, in the world of the worst business, that we begin to see why the magic formula makes sense. And so, our journey begins. Chapter 1. The worst business in the world. Imagine this. You save money, put in your time and energy, and start a business. At first, it feels exciting. Customers arrive, the shelves are full, the doors are open. But soon, a harsh reality sets in. The more you sell, the harder it is to make real profit. Every dollar earned is eaten by costs. Competitors are always undercutting you. Customers switch to another shop if your prices rise even slightly. Months of hard work feel like running on a treadmill. Your bank account barely grows. This is what Joel Greenblatt calls the worst business in the world. A business that consumes capital but does not create wealth. No matter how much effort you invest, returns remain tiny. It is like filling a bucket full of holes. No matter how much water you pour in, it leaks out. Which industries fall into this trap? Airlines are a classic example. From the outside, airlines look glamorous. Jets soaring in the sky. Famous brand names. Millions of passengers. Behind the scenes, they fight an endless battle. Fuel costs, staff salaries, maintenance, airport fees, and regulations constantly pressure profits. Passengers care mostly about price, not loyalty. If one airline drops its ticket price slightly, customers switch instantly. Discount wars destroy profits. Many airlines fail again and again. Supermarkets are another example. They compete fiercely on prices for bread, milk, and everyday goods. Profit margins are razor thin. Even large sales volumes do not translate into high profits. Operating costs are huge, including rent, staff, and stock. Competition consumes most gains. Greenblatt explains that these businesses are not poorly run by choice. The industry structure itself limits profit. There is no protection, no competitive advantage, no moat. Without a moat, competitors destroy profits. Hard work benefits customers more than owners. Why does this matter for investors? The stock market is full of companies, many of them like airlines or supermarkets. Big, visible, and famous, yet poor at generating real returns. If you invest in such companies, your money faces the same struggle. Your return mirrors the business's weakness. Greenblatt teaches a vital lesson. Not all companies are equal. Size or fame does not make a company a good investment. The critical measure is how much profit the company earns on every dollar invested. Low return on capital signals a weak business. The worst business in the world requires constant effort and investment, but produces little reward. It drains capital and energy without creating wealth. Owning shares in such companies is like running on a treadmill. You work hard, but you do not move forward. By showing us the worst businesses first, Greenblatt warns investors. Do not fall for big names or familiar brands. Look deeper. Ask how much return they truly earn. If it is very little, walk away. This understanding sets the stage for the next chapter. Once we see what a bad business looks like, we can recognize what a great business looks like. And as investors, that is where we want our money. Now let us explore the other side. What does the best business in the world look like? Chapter 2. The best business in the world. After understanding the worst businesses, it is natural to wonder what makes a company truly great. Joel Greenblatt calls these companies the best businesses in the world. These are businesses that consistently earn high profits on the money invested in them. They do not struggle to survive every month. Instead, they generate wealth for their owners year after year. A great business has several qualities. First, it has loyal customers. People keep coming back because the product or service is unique or highly valued. Second, it has pricing power. It can charge more without losing customers. Third, competitors cannot easily copy it. There is something special about the company, its brand, technology, or position in the market. Finally, it uses its resources efficiently. Every dollar invested produces a large return. Think about companies like Coca-Cola. People around the world recognize the brand. They are willing to pay for it, even if cheaper alternatives exist. The company invests in bottling plants, marketing, and distribution. Every dollar invested generates more profit than a typical business. This is the essence of a high return on capital. Microsoft is another example. Its software products have strong market dominance. Switching costs are high for customers, meaning once they use Microsoft, they often stay. Competitors cannot easily replicate the ecosystem. The company uses its capital efficiently to earn more profits. Owning such a business is like owning a money-making machine. Greenblatt emphasizes that great businesses are rare. Many companies are ordinary or weak. They compete mainly on price, offer undifferentiated products, or struggle to keep customers. Finding the best businesses is the first step in smart investing. However, even a great business can be a poor investment if you pay too much for it. If you buy a wonderful company at an extreme price, your potential returns are reduced. For example, paying a fortune for a Coca-Cola stock during a hype period may not earn you much. This leads to the next lesson: the importance of price. The combination of business quality and price is what Greenblatt calls the magic formula. You want a company that is both great and undervalued. Buying a cheap but mediocre company is risky. Buying an excellent company at a very high price may not reward you well. The sweet spot is the best business you can buy at a fair price. Greenblatt warns that investing is not about luck. It is about logic, discipline, and patience. The market can be unpredictable in the short term, but strong companies with good returns tend to grow over the long term. This is why identifying and owning the best businesses matters. He also explains the concept of a moat. A moat protects profits from competitors. The wider the moat, the safer the business. It is like a castle surrounded by a deep river. Invaders may try to attack, but the moat prevents them from reaching the walls easily. In investing terms, a wide moat means the company can earn high returns for a long time. Owning a business with a wide moat is satisfying for investors. It generates wealth reliably. It reduces the risk of permanent loss of capital, and it allows investors to sleep well at night, knowing their money is working efficiently. This chapter makes the contrast clear. The worst businesses trap capital and offer little reward. The best businesses multiply wealth and protect investors. Understanding this distinction is essential before we discuss how much to pay for these businesses, because even the best business can become a bad investment if the price is too high. In the next chapter, Greenblatt addresses this crucial question. So what should I pay? How do we combine business quality with price to maximize returns? This is where the magic formula truly begins to take shape. Chapter 3. So what should I pay? Understanding the best businesses is only half the battle. The next question every investor must ask is simple but crucial. How much should I pay for a stock? Even the most profitable wide moat business can become a poor investment if bought at the wrong price. Pay too much and your returns shrink. Pay too little and you might find a hidden gem that grows your wealth substantially. Joel Greenblatt emphasizes that the value of a business is not just its size, brand, or popularity. It is about the profits it generates compared to the price you pay. He introduces the concept of earnings yield. This measures how much money the company makes for each dollar you invest in its stock. A high earnings yield means you are buying the business at a bargain relative to its profits. A low earnings yield means you are paying too much. Imagine two companies. Both are excellent businesses with strong moats. One is trading at a very high price. The other is trading at a reasonable or low price. Which one would you choose? Logic says the cheaper one. The cheaper company offers a better chance to earn higher returns over time. Greenblatt warns that investors often make a common mistake. They fall in love with famous brands or trendy stocks. They ignore the price they are paying. They assume that a successful company will always reward them. But even the best business can disappoint if the price is too high. This is why evaluating value is as important as evaluating quality. He explains that the market is emotional. Prices fluctuate based on moods, news, and short-term events. Sometimes great companies are overpriced because everyone is excited about them. Sometimes mediocre companies are cheap because everyone is pessimistic. A disciplined investor learns to ignore the crowd and focus on the true underlying value of the business. This leads to the idea of combining two measures: business quality and price. You want companies that are both excellent and attractively priced. This combination increases the odds of strong investment returns. It is not a guarantee of success in the short term, but over years, it works consistently. Greenblatt also reminds us that patience is essential. Even if you buy a great business at a good price, the stock may not rise immediately. The market does not always recognize value quickly. There will be times when your investment seems stagnant or even disappointing. But history shows that sticking to quality businesses bought at reasonable prices pays off in the long run. The key lesson is simple: price matters as much as quality. Do not be seduced by famous names or temporary trends. Look at the underlying economics of the business. Ask yourself, am I paying a fair price for the profits this company earns? If the answer is yes, the odds are in your favor. By focusing on both quality and price, investors can avoid two major pitfalls. They avoid wasting money on weak businesses, and they avoid overpaying for even the strongest businesses. This balance is the foundation of what Greenblatt calls the magic formula. It is a methodical, disciplined approach to investing that ordinary people can apply. Understanding price relative to quality leads directly into the next step. Once we know which businesses are attractive and what a fair price is, we can identify the winners. In the next chapter, Greenblatt shows us exactly which companies make the cut and why. It is where theory turns into action, and where investing becomes more than guesswork. Chapter 4. And the winner is. After learning how to judge a business and what price to pay, the natural question is this: which companies should you actually buy? Joel Greenblatt calls this moment picking the winners. The goal is simple. You want companies that are both high quality and reasonably priced. This combination gives the best chance of earning strong returns over time. Greenblatt explains that the stock market is not always logical in the short term. Sometimes bad businesses are rewarded with high prices. Sometimes excellent businesses are ignored. But over the long term, true value wins. A company that earns high profits on its capital and is cheap compared to those profits will eventually show its worth. He introduces the idea of ranking companies. Every company can be evaluated by two main factors. First, the return on capital. Second, the earnings yield, which measures how cheap or expensive the stock is. Each company gets a rank for quality and a rank for price. Then these ranks are combined to create a list of potential winners. The higher the combined rank, the more attractive the stock is for investment. Greenblatt emphasizes diversification. You do not want to rely on just one or two companies. Even great businesses can face setbacks. Instead, buying a portfolio of 20 to 30 stocks spreads risk while keeping potential rewards high. This method follows the logic of probability. Not every pick will succeed, but the overall strategy produces strong results over time. He also reminds readers to be patient. The market may not recognize these winners immediately. Stocks can stay undervalued for months or even years. During this time, it is easy to feel frustrated or doubt the strategy, but discipline pays off. The magic formula is designed to work over the long term, not overnight. Greenblatt uses simple examples. Imagine two companies with similar profits. One is cheap compared to its earnings, the other expensive. Even if both are great businesses, the cheaper company is likely to earn more for the investor. The market eventually corrects these mispricings. Investors who stick to the formula benefit when that correction happens. Another important lesson is avoiding emotion. Investing is not about excitement or hype. It is about methodically following a proven approach. The winners are determined by numbers, not by what everyone else is buying. This removes guesswork and reduces the influence of market moods. By now, it is clear how the magic formula works in practice. Step 1. Find high-quality businesses. Step 2. Determine which ones are undervalued. Step 3. Combine the rankings and pick a diversified set of winners. Step 4. Hold them patiently and repeat the process every year. Greenblatt also warns against chasing short-term performance. The formula may look like it is failing in a given year. This is normal. Over the long term, however, the winners consistently beat average market returns. Understanding who the winners are prepares us for the next chapter. Greenblatt explains a key analogy to help investors think about stocks rationally. He compares investing to machines, showing how long-term thinking overcomes short-term noise. This sets the stage for the chapter Voting Machines and Weighing Machines. Chapter 5. Voting Machines and Weighing Machines. Joel Greenblatt introduces a key idea about how the stock market works. He says that in the short term, the stock market acts like a voting machine. In this mode, stock prices move up and down based on popularity, rumors, or news. People vote with their money, and the result may not reflect the true value of the business. A mediocre company can appear successful if everyone wants to buy its stock. A great company can seem weak if no one is paying attention. In the short term, emotions dominate. Greed and fear drive decisions. Investors often panic when prices fall or get excited when prices rise. This behavior creates temporary mispricings. It is like a popularity contest where the loudest voices win. However, in the long term, Greenblatt says the market is more like a weighing machine. A weighing machine measures real value. Over time, the true quality of a business, its profits, efficiency, and growth, will be reflected in its stock price. The magic formula relies on this long-term perspective. It is not about guessing which stock will be popular next month. It is about owning great companies at fair prices and letting time show their worth. He explains that investors often make the mistake of focusing only on short-term results. Stock prices fluctuate daily, weekly, or monthly. Many people worry when a stock falls temporarily. Some sell in panic, locking in losses even though the company itself is strong. Others buy hype stocks, hoping for quick gains, ignoring the actual business quality. Greenblatt emphasizes that these actions reduce returns and increase risk. To succeed, investors must think like long-term owners. They must ignore the daily voting machine and focus on the weighing machine. This means analyzing earnings, return on capital, and valuation. It means buying solid businesses and holding them through short-term fluctuations. Over years, the market rewards patience and rational analysis. Greenblatt also notes that the market is not always fair. Short-term noise can last months or years. But history shows that eventually, great businesses command higher stock prices. Poor businesses, even if temporarily popular, eventually lose value. This principle is what makes the magic formula effective. He uses simple analogies to explain this. Think of a company like a well-built bridge. Short-term investors focus on which side looks busy today. Long-term investors measure the strength of the bridge itself. A strong bridge will hold heavy loads over time, regardless of temporary traffic. Similarly, a strong business will create wealth over time, regardless of short-term market moods. Greenblatt stresses the importance of discipline. The magic formula works because it is systematic. It does not rely on guessing, trends, or timing the market. It relies on consistent evaluation of quality and price. Investors who stick to this approach can take advantage of the short-term chaos while benefiting from long-term value. By understanding voting machines versus weighing machines, we see why patience is critical. We also understand why following a formula is better than following emotions. This prepares the reader for the next chapter, where Greenblatt explains how eliminating unnecessary middlemen can further improve returns. The chapter, Cutting Out the Middleman, builds directly on this concept, showing how investors can take control of their own wealth. Chapter 6, Cutting Out the Middleman. Most investors rely on other people to manage their money. They hire fund managers, pay financial advisors, or buy expensive investment products. Joel Greenblatt argues that this often reduces returns rather than increasing them. The middlemen take fees, commissions, and sometimes poor advice. Even professional fund managers often underperform the market over time. Greenblatt explains that ordinary investors can take control themselves. They do not need to pay high fees for expertise they can learn and apply on their own. With a simple, disciplined approach like the magic formula, anyone can manage their investments effectively. The key is following a clear system, rather than trying to guess what the market will do next. He points out that every fee, commission, or unnecessary expense reduces wealth. If a fund manager charges 2% annually, that is money leaving your account, even before the market moves. Over decades, these small percentages add up to a huge difference in overall returns. Cutting out the middleman allows investors to keep more of the profits that come from smart investing. Another important point is transparency. When you manage your own money, you know exactly what you own and why. You are responsible for your decisions, which encourages discipline and careful analysis. You also avoid the temptation to follow hype or herd behavior, which is common when relying on others. Greenblatt emphasizes that the magic formula is simple enough for individuals to use. It does not require a team of analysts, complicated computer models, or insider information. All it requires is patience, understanding, and a willingness to follow a proven system. By applying the formula yourself, you remove unnecessary costs and take advantage of the long-term power of value investing. He also notes that people often make the mistake of reacting emotionally to short-term results. Professional managers may sell too early or buy too late based on market trends or client pressure. Individual investors who stick to a clear plan avoid these mistakes. They are less likely to sell undervalued stocks in panic or buy overvalued stocks in greed. Greenblatt warns that cutting out the middleman does not mean cutting out responsibility. You must still learn the principles of investing and follow them carefully. Blindly applying a formula without understanding it is risky, but once you understand the logic, you gain both control and freedom. By managing your own investments, you can fully benefit from the magic formula. You can buy high-quality, undervalued companies, hold them patiently, and reinvest profits without losing a large portion to fees. This approach amplifies the power of time and compounding. It also aligns perfectly with the long-term mindset described in the previous chapters. Understanding how to cut out the middleman prepares us for the next step. Greenblatt now shows a working formula that combines quality and price into a practical method for picking stocks. The chapter A, Working Formula, turns all the theory into actionable steps that ordinary investors can follow easily. Chapter 7, A Working Formula. Now that we understand the importance of business quality, price, patience, and cutting out the middleman, Joel Greenblatt introduces the core of his approach, a working, practical formula. This is the famous magic formula, and it is designed to be simple enough for ordinary investors to use yet powerful enough to beat the market over time. The magic formula combines two key measures: The first is the return on capital. This tells us how efficiently a company generates profits from the money invested in it. High return on capital indicates a strong business with a durable competitive advantage, or moat. The second measure is earnings yield. This tells us how cheap the stock is compared to the profits it earns. A high earnings yield means the stock is undervalued, giving the investor a potential bargain. Greenblatt explains that the magic formula ranks companies on both measures. Each company receives a rank for quality and a rank for price. These ranks are then combined to create a list of attractive stocks. The higher the combined rank, the more appealing the investment. By following this systematic ranking, investors can identify companies that are both excellent and inexpensive. He emphasizes that the formula is not about guessing which stock will go up next week. It is about creating a disciplined method for buying good businesses at reasonable prices. Over time, these companies tend to outperform the broader market. The magic formula turns investing from speculation into a logical, repeatable process. Greenblatt also provides guidance on portfolio construction. He suggests buying about 20 to 30 stocks from the list generated by the formula. This number balances risk and opportunity. It ensures diversification while still allowing investors to benefit from high-quality selections. Holding this portfolio for a year and then re-ranking and replacing stocks keeps the strategy disciplined and current. He stresses the importance of consistency. Do not try to pick only a few favorites. Do not chase the stocks that are temporarily popular. The formula works best when applied consistently, year after year. Short-term fluctuations are irrelevant. The goal is long-term performance. Another key point is simplicity. The magic formula is not complicated. It does not require advanced calculations, inside information, or expensive software. It is a clear, logical approach that anyone can understand and follow. This simplicity is what makes it accessible to ordinary investors, not just Wall Street professionals. Greenblatt also reminds us that patience is essential. Even when the formula seems to underperform in the short term, the long-term results are proven to be strong. The market may temporarily misprice stocks, but over time, the true value of high-quality businesses shines through. By following this working formula, investors can remove emotion from investing. They no longer need to guess which companies will be popular. They no longer need to react to daily market noise. Instead, they rely on logic, data, and discipline. This chapter sets the foundation for the next step. Once we understand how the magic formula works, Greenblatt shows how to sum it all up and apply it in real-life investing. The next chapter, and to sum it all up, ties the lessons together and reinforces the power of a systematic approach. Chapter 8, and to sum it all up. Now that we have explored every element of the magic formula, it is time to bring it all together. Joel Greenblatt believes that investing does not have to be complicated, confusing, or intimidating. It can be logical, disciplined, and accessible to anyone who is willing to follow a simple system. At the heart of this approach are three key principles. First, focus on business quality. Invest in companies that earn high returns on capital. These are businesses with durable competitive advantages, strong moats, and efficient operations. They create wealth consistently and are less likely to fail in the long run. Second, focus on valuation. Do not overpay for a company, no matter how popular or well-known it is. Look at earnings yield and rank companies accordingly. Paying a fair or below-market price increases the potential for higher long-term returns. This combination of quality and price is what Greenblatt calls the magic formula. Third, practice patience and discipline. The market acts like a voting machine in the short term, but a weighing machine over the long term. Stocks will fluctuate in price. Sometimes they will feel overpriced, undervalued, or stagnant. But if you follow the formula consistently, the long-term results have historically been impressive. Greenblatt also stresses diversification. Owning 20 to 30 stocks spreads risk without diluting opportunity. It ensures that temporary setbacks in one stock do not derail the entire portfolio. Consistency in applying the formula is more important than trying to predict short-term winners or market trends. He reminds us to avoid emotion. Investing is not about excitement, fear, or trying to outsmart others. It is about methodically applying a proven system. The magic formula removes guesswork. It allows ordinary investors to act logically without being swayed by hype or panic. Greenblatt uses examples to illustrate his point. Great businesses bought at reasonable prices consistently outperform over time. Weak businesses or overvalued stocks fail to deliver, even if they are popular. Following a systematic approach separates disciplined investors from those who rely on luck, speculation, or emotion. This chapter also reinforces a vital lesson from earlier chapters. Cutting out the middleman allows you to keep more of your profits. Managing your own portfolio with the magic formula reduces fees, commissions, and unnecessary complexity. It gives you control, transparency, and confidence in your investing decisions. Finally, Greenblatt emphasizes the importance of time. The magic formula is not about quick wins. It is about steadily compounding wealth over years. The longer you stick with the strategy, the more powerful the results. Patience and discipline are as important as the formula itself. By summing up all the lessons, Greenblatt shows that successful investing does not require genius, insider knowledge, or luck. It requires logic, discipline, and a clear system applied consistently. The magic formula offers a roadmap for ordinary investors to beat the market without overcomplicating the process. This chapter prepares the way for the next one. Even with a great formula, Greenblatt warns, trust no one. Investors must rely on their own understanding, not promises, hype, or unverified advice. The next chapter shows how skepticism and independent thinking strengthen long-term results. Chapter 9. Trust no one. Even with a proven system like the magic formula, Joel Greenblatt emphasizes one critical principle: trust no one blindly. Investing is full of advice, tips, and opinions. From financial news anchors to popular bloggers, everyone claims to know the next big stock or the secret to instant wealth. But relying on someone else's recommendation without understanding the fundamentals is risky. Blind trust can lead to losses, frustration, and missed opportunities. Greenblatt warns that many investors fail because they assume experts always know best. Mutual funds, brokerage reports, and analyst recommendations often serve other interests. Fees, incentives, or corporate pressures can distort advice. Even well-intentioned professionals can be wrong. Markets are unpredictable, and short-term trends often mislead. Investors who follow advice without question risk paying too much or buying weak companies. The solution is simple. Do your own homework. Understand the business you are investing in. Look at the profits, returns on capital, and valuation. Apply the principles of the magic formula. Make decisions based on logic and evidence, not hype or emotion. This approach reduces the influence of outside noise and empowers you to act with confidence. Greenblatt also points out a psychological challenge: overconfidence in others. Many investors assume that someone else is always smarter or better informed. This belief can lead to neglecting research, making impulsive trades, or following the crowd. Over time, these behaviors erode returns. Investing requires skepticism. Trust in the process, not in opinions. He encourages readers to think like business owners. When you buy a stock, you own a small piece of a company. Would you trust a stranger to manage your business without understanding its numbers, operations, and prospects? Probably not. Similarly, you should take responsibility for your investments. Knowledge, discipline, and independent thinking are your most valuable tools. Greenblatt emphasizes that skepticism is not pessimism. It is critical thinking. You can still be optimistic about investing, but optimism should be grounded in evidence, not blind belief. By questioning assumptions and verifying facts, you avoid common mistakes. You also develop the discipline to stick with high-quality, reasonably priced businesses, even when the market seems unpredictable. Another lesson is patience. Even when a company looks undervalued, or the magic formula identifies a winner, results may take time. The market may temporarily misprice stocks. Investors who rely solely on others may panic during these periods. Independent thinking allows you to hold your positions confidently, knowing the long-term logic is sound. Ultimately, trust no one reinforces all previous lessons. Quality matters, price matters, patience matters, and control matters. External opinions can be helpful, but should never replace your own analysis. The magic formula works best when combined with independent judgment, discipline, and skepticism. This chapter leads naturally into practical examples. In the next chapter, The Magic Formula at Work, Greenblatt demonstrates how this system performs in real life. He shows investors how to apply the formula step by step, and how logic and patience translate into consistent long-term results. Chapter 10. The Magic Formula at Work. By now, we understand the principles behind the magic formula: high-quality businesses, reasonable prices, patience, discipline, and independent thinking. Joel Greenblatt now shows how this system works in real life. Applying the magic formula is straightforward, yet its power comes from consistent execution over time. Greenblatt starts by explaining the process step by step. First, identify companies with high returns on capital. These are businesses that efficiently convert invested money into profits. Next, evaluate earnings yield to determine which of these high-quality companies are undervalued. Combine the rankings to create a list of attractive stocks. From this list, select 20 to 30 companies to build a diversified portfolio. He emphasizes simplicity. You do not need to track every stock in the market. You do not need complicated models or insider knowledge. The magic formula relies on clear, publicly available data: profits, capital invested, and stock price. By following the rankings methodically, ordinary investors can compete with professionals. Greenblatt also demonstrates the importance of rebalancing. Every year, review your portfolio. Sell stocks that have risen too high or no longer meet the criteria. Replace them with new stocks from the updated rankings. This ensures that your portfolio remains disciplined and aligned with the principles of the formula. He shares examples of how the formula has worked historically. Stocks chosen based on combined quality and valuation tend to outperform over time. Even if some individual picks fail or underperform temporarily, the overall portfolio produces strong returns. This is the power of diversification and disciplined application. Another key point is patience. Short-term results may fluctuate. Stocks may stay undervalued for months or years. It can be tempting to sell in frustration or follow popular trends. However, Greenblatt emphasizes that long-term thinking is essential. The magic formula is designed for multi-year performance, not overnight success. He also notes behavioral lessons. Investors must resist emotion, hype, and fear. The formula works best when applied systematically and consistently, regardless of short-term market movements. Trusting the process, rather than reacting to noise, is crucial for achieving the formula's potential. Greenblatt explains that the magic formula works in almost all markets. It is not tied to a specific industry, geography, or economic cycle. By focusing on fundamental principles, profitability, valuation, and consistency, investors can identify winners across sectors and countries. Finally, he illustrates compounding. Holding high-quality, undervalued businesses allows investors to reinvest earnings, which grows wealth exponentially over time. Small, consistent advantages in returns accumulate into significant gains over decades. This demonstrates that investing is not about luck or speculation. It is about logic, discipline, and patience executed over the long term. By seeing the magic formula at work, readers gain confidence in applying it themselves. The next chapters explore practical considerations, including taxes and returns, showing both the challenges and advantages of long-term investing. Greenblatt explains what to expect and how to maximize results while minimizing unnecessary losses. Chapter 11. Taxes and Investment Returns. The bad news. Even the best investing strategy faces challenges. Joel Greenblatt explains that one of the biggest obstacles to maximizing returns is taxes. Taxes are unavoidable. They reduce the amount of money investors keep from profits, dividends, and capital gains. Understanding their impact is crucial for long-term wealth building. Greenblatt begins by explaining how taxes affect investment returns. When you sell a stock for a profit, capital gains taxes apply. These taxes reduce the effective return on your investment. For example, if your stock earns 20%, but you pay a significant portion in taxes, your net gain is much lower. Even dividends are taxed, further cutting into total returns. He also points out that frequent trading amplifies the problem. Buying and selling stocks too often generates short-term capital gains, which are typically taxed at higher rates. Many investors, trying to chase quick profits, end up paying large portions of their earnings to the government. Even though they appear successful on paper, their after-tax returns are disappointing. Another issue is the emotional effect of taxes. Investors sometimes sell winners too early to avoid taxes, missing out on long-term growth. Or they hold losers too long in an attempt to defer taxes, tying up capital in unproductive investments. These behaviors reduce overall returns and make investing more stressful than necessary. Greenblatt explains that taxes are one reason the magic formula works best when applied systematically. By holding a diversified portfolio of high-quality, undervalued companies for a year or more, you reduce the frequency of taxable events. This approach minimizes short-term gains and allows compounding to work more efficiently. The formula encourages long-term thinking, which not only increases returns, but also mitigates tax impact. He also warns that investors should be aware of different tax rules in their countries. Local regulations, capital gains rates, and retirement account rules all influence net returns. Even small differences in tax treatment can have a large effect over decades of investing. Greenblatt stresses that while taxes are unavoidable, they should not prevent disciplined investing. The goal is not to eliminate taxes completely, which is impossible, but to manage them intelligently. Strategies like long-term holding, reinvesting dividends, and using tax-advantaged accounts help investors keep more of their profits. Finally, he explains that understanding the bad news about taxes sets the stage for the good news. Even though taxes reduce returns, disciplined investing, compounding, and the magic formula can still create substantial wealth over time. The next chapter, Taxes and Investment Returns. The good news shows how investors can structure their approach to maximize after-tax results and keep more of the wealth they create. Understanding the limitations imposed by taxes is essential. It teaches patience, reinforces long-term thinking, and highlights the importance of systematic investing. By facing the reality of taxes, investors prepare themselves to implement strategies that truly work. Chapter 12. Taxes and Investment Returns. The good news. After discussing the challenges taxes pose, Joel Greenblatt shares the good news. Even with taxes, disciplined investing can generate outstanding returns. The magic formula and long-term strategies are designed to work despite tax obligations, allowing investors to grow wealth steadily over time. Greenblatt begins by emphasizing long-term holding. By keeping high-quality, undervalued stocks for a year or longer, investors reduce the frequency of taxable events. Capital gains taxes are deferred, allowing compounding to work more powerfully. The longer profits remain invested, the more wealth grows before taxes are paid. Time becomes an investor's ally. He also explains that dividends can be reinvested to maximize growth. Even though dividends are taxed, reinvesting them in additional shares allows profits to compound faster. Over decades, reinvested dividends significantly increase total returns. This strategy demonstrates how disciplined behavior overcomes the drag of taxes. Greenblatt points out that systematic investing reduces emotional mistakes. Investors who follow the magic formula do not chase hype or panic during market fluctuations. They avoid frequent trading that generates short-term taxes. Instead, they focus on logical, consistent application of the formula, which naturally reduces unnecessary tax events. Another benefit is diversification. By holding 20 to 30 carefully selected stocks, investors reduce the risk of one poor-performing company dominating their portfolio. This balanced approach smooths returns and minimizes the need for reactive trading, further lowering taxable transactions. Greenblatt also introduces the idea of tax-advantaged accounts. Using retirement accounts, tax-free growth accounts, or deferred tax vehicles allows investors to shelter gains from immediate taxation. While these strategies do not eliminate taxes, they provide flexibility and enhance overall after-tax returns. He stresses that the magic formula is compatible with these approaches. The simplicity and discipline of the formula make it easy to apply in taxable and tax-advantaged accounts alike. Investors do not need to complicate their strategy or chase tax loopholes. Following the formula patiently ensures wealth grows consistently even after accounting for taxes. Finally, Greenblatt reminds readers that taxes are a cost, but they are not a reason to avoid investing. The real danger lies in inaction, emotional decision-making, or overpaying for stocks. By focusing on quality businesses at reasonable prices, holding them patiently, and using compounding intelligently, investors can build wealth that far exceeds the impact of taxes. This chapter sets the stage for understanding long-term persistence. Even when the formula appears to underperform temporarily, the principles of compounding and disciplined investing continue to work. The next chapter, the magic formula is always working. Even when it looks like it is not, explains why patience and consistency are the keys to long-term success. Greenblatt's good news is simple. Taxes reduce profits, but they do not stop disciplined investors from winning over time. By understanding how to work with the system, investors can achieve reliable, growing wealth while minimizing the impact of taxes. Chapter 13. The magic formula is always working, even when it looks like it is not. One of the most important lessons Joel Greenblatt teaches is that the magic formula works consistently, even when the market seems unpredictable or uncooperative. Investors often panic when their portfolio underperforms temporarily. Stock prices fluctuate daily, weekly, or even monthly, but these short-term movements do not reflect the long-term value of a business. Greenblatt explains that the market behaves like a voting machine in the short term. Popularity, hype, fear, and rumors can drive prices up or down, sometimes for no logical reason. During these periods, even excellent companies may appear stagnant, and poor companies may seem to thrive. This short-term noise can make the formula appear ineffective, but it is only temporary. In the long run, however, the market acts like a weighing machine. The true value of a company, its profits, efficiency, and return on capital, eventually becomes reflected in the stock price. High-quality, undervalued businesses rise over time. Low-quality or overpriced businesses eventually decline. This principle has been demonstrated across decades of historical data. Greenblatt emphasizes patience. Investors must resist the urge to react to short-term results. Even when the portfolio seems to underperform, the logic of the magic formula remains sound. Compounding, consistent application, and careful selection of stocks drive long-term outperformance. The formula does not rely on luck or timing. It relies on discipline. He provides examples of past market behavior. There are years when the magic formula outperforms dramatically, and years when it seems to lag. What matters is the long-term average. Over 5, 10, or 20 years, the consistent application of the formula generates superior returns compared to the market as a whole. Investors who panic and abandon the formula too early often lose the advantage. Greenblatt also highlights behavioral lessons. Humans tend to overreact to short-term news. They sell undervalued stocks during temporary dips and buy overvalued stocks during fads. The magic formula removes emotion from investing. It provides a systematic, repeatable method that works even when the market seems irrational. Another key point is consistency in execution. Re-ranking stocks annually, maintaining diversification, and sticking to the system ensures that temporary underperformance does not derail long-term gains. Patience and faith in the process are critical. Finally, Greenblatt reassures investors that perceived underperformance is often part of the system working correctly. Short-term market fluctuations can create opportunities to buy high-quality businesses at attractive prices. By trusting the process and remaining disciplined, investors can take advantage of these opportunities rather than fear them. This chapter naturally sets up the final principles. Even with a proven system, investors must consider their own behavior, taxes, and long-term application. The next chapter, the final word, ties all lessons together and reminds readers how simplicity, discipline, and patience can create lasting investment success. Greenblatt's message is clear. The magic formula never stops working. Temporary setbacks are not failures. They are part of the system's rhythm, rewarding disciplined investors who stay the course. Chapter 14. The Final Word. After exploring every principle, formula, and example, Joel Greenblatt concludes with a clear message. Investing can be simple, logical, and successful when approached correctly. The magic formula is not a secret or a shortcut. It is a disciplined, systematic method that combines quality, value, patience, and consistency to generate long-term returns. Greenblatt reminds readers of the core lessons. First, focus on high-quality businesses that earn strong returns on capital. Second, pay attention to price. Buying good companies cheaply increases the probability of long-term gains. Third, be patient and disciplined. Ignore short-term market noise, trust the process, and allow compounding to work over years. He also emphasizes independence. Trust no one blindly. Rely on your own analysis and understanding rather than tips, hype, or popular opinion. The magic formula gives a framework, but it requires the investor's commitment and rational judgment to succeed. Greenblatt revisits behavioral lessons. Human emotions, fear, greed, and impatience, are the greatest threats to investment success. The magic formula helps mitigate these emotions by providing a clear, repeatable process. By following it consistently, investors avoid impulsive decisions that erode returns. Taxes and costs are also important considerations. Greenblatt acknowledges that taxes and fees reduce returns, but they do not negate the power of disciplined investing. Using tax-efficient strategies, minimizing unnecessary trading, and reinvesting profits enhance the effectiveness of the formula. He reminds investors that the market may not always be rational. Stocks may stay undervalued or overvalued for months or even years. This is normal. Long-term thinking is the key to success. The magic formula works over time because it focuses on the true value of businesses rather than popularity contests or short-term trends. Greenblatt also emphasizes simplicity. Investing does not require complicated models, insider information, or constant monitoring of every market movement. A clear understanding of quality, price, and patience is sufficient. This simplicity makes the approach accessible to ordinary investors while remaining powerful enough to outperform the market. Finally, he encourages discipline in execution. Follow the formula consistently, diversify your portfolio, and review it annually. Avoid emotional reactions to temporary underperformance. Rebalance, reinvest, and remain committed to the long-term process. The combination of logical analysis, systematic application, and patience leads to consistent wealth creation. Greenblatt concludes by reminding readers that investing is a marathon, not a sprint. The magic formula is a tool to guide disciplined investors through the inevitable ups and downs of the market. By trusting the process and avoiding common mistakes, anyone can achieve long-term financial success. The final word is simple. Quality, value, patience, discipline, and independence are the pillars of successful investing. Apply them consistently, ignore short-term noise, and the results will speak for themselves. The magic formula is not a promise of instant wealth. It is a proven roadmap for long-term prosperity. With these principles, investors are equipped to act confidently, manage their own portfolios, and take control of their financial future. Investing, when approached correctly, is not complicated. It is logical, disciplined, and ultimately rewarding. Thank you for listening to The Little Book That Still Beats the Market by Joel Greenblatt. If you enjoyed this audiobook-style summary and want to explore more insights on investing, personal finance, and wealth-building strategies, make sure to subscribe. Subscribing ensures you never miss future summaries, practical tips, and lessons from some of the greatest minds in finance.